Oh, good question. Okay, how come the third one was not included in incremental allowance? And it has to do with this. The book value is higher than the book value is higher than the increment. So in other words, nothing more could go wrong in that increment than already has. So because of that, we won't have any incremental allowance. That, you know, is 13,000 is the most that it will be off in that interval, because this covers the entire interval. This may even cover 2 intervals, to be honest. But 13,000 is the most that it could be off. Whereas these other ones, if you look at it, you know, this is off by, this is 20,000. Well, there's a lot, you know, there's never 80,000 in that interval that could go wrong. So it kind of has to do with the probability that there's other things wrong when there's a misstatement. So yeah, so that's why that this is not included. Oh, I didn't, what did I do here? Well, hold on a second. I didn't answer these. That's a problem. So you'll notice that these two, let's take a look at these other two. You notice that these are less than the interval. So if there's a problem in the interval, there could be more problems in there. You know, this is 12,000. There could be another 88,000 dollars in there that could have potentially more misstatements. And the idea is that if there's a misstatement, that first of all, it kind of proves that they're possible, but also it matters what size of misstatement it is. Now, this misstatement is not projected. This is not a projected amount. This is an actual misstatement. Oops. Caps out here. So this one's a little bit different than the other ones in that this is, you know, this is actually off by 13,000. You'll probably give that to them and have them make that correction. Right, and notice what's happening here. You know, if this was, you'd probably hand this to them too, but their actual correction for that item would only be 5,000, even though the projected misstatement is 25. So the projected is more, whereas this is an actual amount. This is a projection. Now we put it in the projected ones. Yeah, so it is kind of quirky though. I mean, it's, you know, it's quirky. Now, but here's the nice thing about this is that if someone is trying to cook the books, the more they increase something, the more likely it is to get caught. And this one would be caught 100%. You know, so if this was fraud, and I don't know if it is or not, it could be a mistake, but if this was fraud, by increasing it by 13,000, they guaranteed that it would be picked. Yeah. Okay, so let me see here. Is that right? Where's my focus going? Okay, so here's kind of what's kind of happening on it. The client's saying that it's worth 2 million. We're saying, okay, this is our best estimate is that it's at, you know, 2 million minus 138,000. This is our best estimate. However, because this is a sample, it could be worse. Basic precision, and this is if there are no misstatements. You know, so sort of like this. Yeah, I knew I was going to make a mess out of this when I saw it. All right, so this is the 231 is, if there were no misstatements, this could still be off by 231,000. This is at the 10% level. And the incremental allowance and this is for misstatements. Now, if you don't have any misstatements, you're not going to have an incremental allowance. You know, if there are no misstatements, that'll be it. If you do have misstatements, it says, okay, well, this could be off even more. You know, so that's how we come up with the total is the basic precision says, okay, this is a sample. So even if you don't find any misstatements, there's a possibility that there are misstatements. And then if you do have misstatements, the incremental allowance says, okay, misstatements you have, the size of them matters. Big misstatements mean there's a bigger chance that this is going to be, you know, off by more. So this is our best estimate. That it's off by 138. That's our projected misstatement. This has to do with, this is a sample, and so it could go down even more. So the total is or something. 438. So we're saying that this could be actually off by 438. You know, all these together, 438 is what it could be off by. Which, it's only $2 million. That's, you know, to be off by almost $500,000. Quite a bit. You know, it makes these a little more exciting than they probably need to be. Yeah. Any other question on this thing? So yeah, the wacky ones are these ones that are more than the interval are wacky. And then these are wacky too, that they're understatements. And I know that, you know, as an auditor, when I see something that's misstated, I say, oh, wait, this is misstated. This is the problem, not in this method. For this method, if it is, if it's an understatement, we ignore it. Which, again, Kevin goes against your grain as an auditor. You know, generally, you want to, whenever you see something wrong, you say, wait a minute, there's a problem here. But in this case, you ignore it. Okay, I think we already went over the advantages. We already did this, I think. I must have. Right. This is all highlighted. Yeah. Okay. So that's, I'll put a yeah. Okay, very good. Yeah. So I will put a, let me save this. I'll put a thing for this in the to turn it in Blackboard. Oops, what are we doing here? Oops, not that. Don't want that either. Okay, so okay, there's something I do. I accidentally closed out of what I do need. So that it's my to-do list. What's wrong here? Okay. So tonight, what we're going to do. Oh, wait a minute. I picked the wrong one. There we go. Also, because tonight we just did the monetary unit one, so that'll be there. We're also going to do. Let's start on internal controls. Say chapter 5. This one's a little bit technical. It's not a fun one, to be honest with you. But this is so this is what we're going to start into next, and then we also are going to have a small a case. It's called Fun Footwear or something like that. Okay. Let's go to. Okay, so internal control. Hopefully everybody has this.
Professor, you just emailed this one today, right?
One more time?
You just emailed this one today?
Yeah, it should also be in Blackboard. Let me.
Thank you.
It should be in course files in Blackboard too. Yeah, it is. So yeah, if you didn't get it, check in Blackboard. And well, a couple things about internal controls. Internal controls are probably one of the more difficult things in accounting / auditing. And you'll see all the time, you know, you read about in the news all the time, people, you know, bad things happening because of internal controls. It isn't as, it's not one of those things that is, you know, once you're done, you know, oh, let's do good internal controls, and when you're done with it, you're done with it. There's a big thing on one of the banks paid off some liabilities that they shouldn't have. They paid it off early or something like that. I think was it JP Morgan? I can't remember. But anyway, yeah, literally like $500 million worth of writing up because it was an internal control thing. One of their program, it looked like they were just making a payment, a single payment, and they actually went through and paid billions of dollars. And most controls are not that serious, obviously, but so you do run into these things all the time where there's a problem with internal controls that, you know, it isn't necessarily what you think. It's difficult, and even people that work in the business. I know that when I first started auditing, I was working, you know, as internal auditor, and by the way, in auditing, you know, it's not, as you do an audit, it isn't that you're such a genius you figure out all this stuff. There's actually an audit program that you actually follow, and that audit program will tell you what to do, and you do those things. You can, if you follow the program, you find things that are wrong. And I remember being on an audit, you know, probably 3 or 4 months into my first job, you know, and coming up with these control problems. The first time I had really control problems, and going to this person that had worked in the company for probably 30 years and say, well, you know, there's this, this, and this. And they look at you and they say, well, what do we do? You know, they're, you know, so internal controls are not easy. They're not obvious a lot of times. And that can make them difficult. And, you know, you see them all the time. You're so used to seeing them that a lot of times you don't even notice them. If you go to well, if you go to places, you go to Home Depot. When you leave the store, a lot of times they'll check your basket, right? And they'll say, okay, let's see, did you pay for all this stuff? And you might think, okay, they're checking to see if I stole something. What else might they be checking for though? There's probably much more, much more of a risk for them. It's possible a customer has something in their cart that they didn't pay for. That's possible, but they went through the checkout line. You go through the checkout line, and even then, you go to the door and you pull out your receipt, Walmart or Home Depot or whatever, and they'll check it off. What do you think they're more likely looking for rather than did you as the customer pay for something? What do you think they're more afraid of? They're actually more afraid of employees working cash register and using that as a way to steal things because someone goes through the line and is a friend of theirs or whatever, or a relative or whatever. Employees steal about 6 times more than customers do it, almost any retail store. So for every one person that shoplifts, or dollar-wise, for every $100 that's shoplifted, there's $600 that's stolen by employees, just in general. They're more interested in, they are interested to see if you're trying to steal something, but even more so than that, they're looking to see if the person at the cash register actually rung everything up. Did they ring everything up that they're supposed to? Because that's how they would catch people stealing, and especially for stores that it can be significant how much that comes out of it. So anyway, these are things that even though you see it every day, it may not be obvious exactly what they're doing, and it's just common to see that. You go to a fast food place, you'll pay one person, somebody else will bring the food. Why? But it'd be more efficient just to have one person, give them the money and they give you the food. Why don't they just do that? Because they could take the money and stick it in their pocket. They know how much the food, and they have the food to hand to you. You're not going to complain. That's why they have those things separated out. So segregation of duties. Actually, I don't know if we'll talk about it today, but so a lot of times these internal controls are actually things that are so common that you see so commonly, but the reason for them is not always obvious. Okay, so let's go back to the handout. Excuse me. All right, internal control. They are policies and procedures designed to achieve management's objectives. Now, a reasonable question is, what are management's objectives? They come in 3 flavors. The first one are controls over financial reporting. And this is kind of what we're doing in this class. And that, are they putting out do they have controls over their financial statements and so forth that are going to make that ensure that their financial statements are not materially misstated? Second one, are they have controls over their operations? These would be sort of, a lot of times your management people would have stuff like this. So, for instance, it could be Could be for improvements. Could also be for, say, reorder points for inventory. Could also be for improvements. Company. This is usually done by consulting people. If you do things like the improvements, like operational audits, that's usually consulting. And then lastly, for compliance. Controls over compliance, I should say. Like EPA stuff. Could be EPA, could be taxes, regulation, contracts. So are they complying with EPA rules? Are they complying with the tax rules? Whatever, are their contracts, are they complying with those? So these are the ones that we look at. Now in this class, this is really the one we're looking at, the financial reporting. Okay. Manager's responsibility. Manager is responsible for the design. Let's use a different color. We just use yellow. So how they're designed and how they're implemented is manager's responsibility. It is not the responsibility of auditors. We have no responsibility for the financial statements or the internal controls. I'm gonna put that in. I'm gonna write that in. So auditors are not responsible for the financial statements or internal controls. That's management's job. That is, they're the ones that make them. They're the ones that design them. It's their responsibility. Okay, so the question becomes, well, what are we responsible for? Now, we're not responsible for the financial statements. We're not responsible for the internal controls. Well, what is our responsibility? And this one down here kind of lays it out. This is probably more important than some of this other stuff up here. Okay, for a financial statement audit. So this is what the normal audit we think about. This is for the financial statements to see if they are free of material misstatement. You must test relevant control activities if you're going to rely on them. I'm going to add something else to this. This is out of the book, by the way. You only have to test relevant controls if you're going to rely on them. So if you're not going to rely on the controls, you don't have to test them. However, you are required So you're not required to test them. But you are required to get an understanding. So this is the understanding. This is the idea is that unless you understand their internal controls, you don't know what to look for, what the problem can be. And for a financial statement audit, we don't give an opinion on internal controls. Now we evaluate the internal controls throughout the fiscal year. So this is for the entire year, we will look for internal controls. And this one is a little bit, kind of theoretical a little bit. Okay, so for a financial statement audit, we look at the internal controls for the entire year. So the internal controls in January might be different than they are in December. But if there's a problem in January, we still have to pay attention to that because there could be transactions that were made in January when the controls weren't very good. So when we look at internal control problems for financial reporting, we're looking at the entire year because they made transactions the entire year. So if there's a problem in January, February, whatever, that could have an impact on the financial statements. It could be a problem with them because of weak internal controls early on in the year. So it's throughout the entire year that we will actually look at the internal controls for the financial report for doing a financial audit. Okay, so financial audit, we're required to get an understanding of the internal controls. We don't have to test them unless we're going to rely on them. If we rely on them, we have to test them, but otherwise we don't. You have to get an understanding, and they're for the entire year. Reason being, transactions happen through the entire year. So if it's a problem, we need to take it into consideration because it might mean the financial statements are misstated. It doesn't necessarily mean they're misstated, though. Another thing about a material weakness in internal control, just because there's a material weakness in internal control does not mean the financial statements are materially misstated. The financial statements might be fine, even though there is a material weakness in internal control. For instance, I always use the signing, two people signing the check, that's probably not a material weakness, but two people signing a check over $5,000, just because they didn't do it doesn't necessarily mean that the company's misstating their financial statements. Just because there's not a second signature on there. So, again, a material weakness in internal control does not necessarily mean the financial statements are materially misstated. Okay, but we still have to take into account that they might be because of these the weak internal controls early on in the year. Even if it was fixed before year end, we still have to take it into consideration. Okay, the second type of audit, I got all fuzzy. It's not focusing. Okay, the second type of audit that they have there, and this is generally only done for publicly traded companies, and that is an audit on internal controls. What happens is a company will do an assessment of their internal controls, and the auditors come in and audit that assessment of internal controls. It's a separate audit. So, if it's a private company and they get an audit, they just get a financial audit usually. If it's publicly traded, they get a financial audit and an audit of internal controls. So publicly traded companies have both. An audit of financial statements and of internal controls. One of the almost humorous things about it is that people that wrote the laws about this, Sarbanes-Oxley, people, they're actually two people, Sarbanes and Oxley, that wrote the rules on it, they thought everyone was doing this, and no one was. So doing the assessment of internal controls was completely new for virtually every company when this came out. Now it's commonplace, but so back in the day, so doing the internal controls. So you actually will do a second audit on internal controls. Those are generally only done for publicly traded companies. And the curious thing about those is they only you only write a report on the controls that are in place at year end. So if they had a weak internal control in October and they corrected it, at year end, if it's corrected, there's no problem with it because the internal control report is as of the year end, 12/31. Now, if there's a problem at 12/31 and they correct it in January, you still make the report for 12/31 when the control was not corrected. But, so that is kind of the difference between those two. Financial reporting, we have to look at the entire year because transactions happen during the entire year. If you're just reporting on the internal control, it's just as of the end of the year, the internal controls. So it's a little bit different. But so publicly traded companies will have two audits, one on the financial statements, one on the internal controls. I apologize for that. Let me turn that down. Oh, yeah. Okay. So scope of the audit. Because you're doing it, you are, this different color, how about green? Because this is the whole audit is on internal controls, you're going to test relevant control activity each year. You're going to test everything every year. You don't have to do that for financial auditing, but you have to do that if you're doing an audit over internal control. Now, if you're doing both of these, right, you may as well do the testing on internal control because you have to do it for the one or the other audit, the audit over internal control anyways. By the way, and this is kind of an odd quirk to this, to do the internal control audit, you must also do a financial statement audit. So you can't do this audit unless you've done a financial statement audit also. It doesn't go the other way around though. Oddly, you can do a financial statement audit for a publicly traded company and not do the audit of internal control. But when they get their audit of internal control, they'll have to have somebody do the financial audit again. In reality, these two are going to go together always. No company's going to pay for a financial statement audit and not have them do the internal control audit at the same time because they'll be paying for an audit twice. Okay, in your reporting, because this is an audit of internal control, you are going to give an opinion on the internal control. In financial statement auditing, you give the opinion on the financial statements that they're free from material misstatement. For internal audit, for audit control, internal control audit, I'm sorry. For internal control audit, the opinion is on the internal controls itself. So you'll actually say, whether the internal controls are adequate or not. Okay. Let's see. I need to get more room here somehow. Some of this stuff are kind of the memorization before taking the CPA exam. Control environment factors. This is a little bit old. It's we'll get to the updated one later on in the handout. But this is remembered by IC Hambo. You'll see that. People remember it. And so these are an environment. In other words, the environment we're talking about is inside the company, the environment inside the company. And basically, do the people who run the company, do they have integrity? Are they committed to excellence? Human resource policies and practices, are they, the way that they run the company, is it having all those human resource policies that you would expect that they would have for whatever, medical leave or, employment practices and all that kind of stuff. Assignment of authority. This one's kind of strange. This actually is popping up more and more now. But assignment of authority and responsibility. So authorizations are a big part of it. This one is probably the most important of those. Management philosophy and operating style. And a lot of times you'll see this called tone at the top. You'll see that a lot. Tone at the top means that basically what the people who are the senior people in management, the way that they operate is going to be the way the company operates. So if the tone at the top is professional, the company's gonna be run professionally. If the tone at the top is a bunch of cowboys, then it's going to be a bunch of cowboys. So the tone at the top is actually a very important thing, and they emphasize it in auditing so much because it actually is probably the most important thing when it comes to whether a company will have fraudulent financial statements. How the people at the top view ethics and that sort of thing. Board of directors, audit committee, organizational structure, who reports to what. So these are all part of the things that will have an impact on the controls. Control activities. This used to be called PIPs, but they added one I told you about. Authorization of transactions. This is new. It used to be PIAPS, so now it's PAPIs. Physical controls. For instance, I shouldn't say no one is allowed. So for instance, access to the computer centers is restricted. So if they have a bunch of servers, there's no reason for me to go walking in to a place that has a bunch of servers. They probably have some kind of a key code with a card, identification. Maybe it takes my picture or fingerprint or whatever, to restrict people from going into places they have no business being. So physical controls are part of the internal controls. It could be other things too. It could be if you're a bank, you don't want everyone just walking into the vault and hanging out in there. You restrict who can go in there and when they can go in there, what for, and all that kind of stuff. So physical controls are kind of what they say. It's physically keeping people away from things that they have no business being around. It could be expensive inventory. Sometimes you have a real expensive inventory in an operation, and the controls over that. When I was at US Steel, we had laser cutters that use platinum. There's something in the process that uses platinum in the laser cutters, and so you can imagine that is a expensive thing, and you want to keep people, only people that need to use the platinum in the laser cutters were given access to it. Okay, performance reviews. These are not just for employees. These could be reconciliations, like bank reconciliations. Spelled that wrong. Budgets. It could be other things. It could be operational stuff. Sales and all that. So it isn't just, we're not really talking about just employee reviews. A big one there are budgets. Budgets, when you get up anywhere in management, they're going to give you a budget. So if you have 5 people working for you, there's going to be a budget for your department. One of the controls over someone cooking the books or heirs or whatever is that you have these budgets. So for instance, if we had a, I buy $4 calculator. And someone enters this as a $4 million calculator into the system. It's probably going to hit somebody's budget. And someone's going to, hey, where did this come from? Where's this $4 million coming from? You know, it's a calculator. So if there is, so one of the things about the activities, things like budgets, which may not sound very important, actually is a very important one, because whenever something, an inflated number comes through, it's going to hit somebody's budget, and somebody should, will usually say, "What is this?" And if they don't, it could be very well be fraud. They expected it. Information processing controls. This was at that big JP Morgan thing, I think it was, that I just talked about, that they paid off this thing. It was actually their information system made it look like that they were just paying a monthly payment or whatever, and they ended up paying billions out for some kind of notes or something. But anyway, so information system processing, so things like passwords, authorization. One of the things about information processing, this is, you'll still see some questions on this on the CPA exam that are a little bit outdated. In that it used, in the past, the people, CPAs were, the CPA exam anyway, they were afraid that when you have everything electronic, they'll say, oh, wait, there are no controls because, this is all electronic. People will be making up stuff. You won't have any audit trail. You can't trace things through the system and all that because it's all electronic, and it could all be fraudulent and all that. What they really find out, though, is something you guys probably already know, and that is when you do something on a computer, there's usually so much information that gets saved on it that it's incredible. That you'll know exactly who did it, where they were at, what time of day, down to a 100th of a second when they did this. The controls on computers are generally much better than certainly by doing it the old-fashioned way with pen and paper and all that kind of stuff. So the electronic controls are actually usually pretty good. They're good to the extent that they're almost too good, and that they leave such a path that that the amount of information they leave sometimes can be more of a problem than actually a problem with the stuff itself. Okay, segregation of duties. This I'm going to put on the following page. Do I want to cover this now? I think I cover this later, don't I? I'll do it now. Sorry, guys. Segregation of duties. Now is as good a time as any to do this. Okay, segregation of duties. There are 3 of them, and sometimes 4 segregation of duties. The duties that we segregate are custody of assets, authorizations, and record keeping. And these are the ones that you'll normally see for the segregation duties that have to be segregated. I'll talk about what they are in a second. And you remember it by car. That's not how you spell car. You have to spell car correctly, or else you're not going to remember it. Okay, so segregation of duties. You remember it by car. So C, A, I keep telling you guys about we have this new dog. And right now the thing is upstairs, it makes this weird, it sounds like a cat. It has all these different sounds that it makes. One of the things that it has a weird a cat sound it's making. So if I seem distracted, it's because I got a dog that sounds like a cat. All right, so these are the normal ones you see, and there is one more that is sometimes put on there, and that is reviews. And what they mean by that is usually reconciliations. I'm going to put this one over. So if you're looking at that one, you know, that would be a, oops, a car. This one though, you don't see very often. But sometimes you get government stuff, segregation of duties, they'll have that listed separately as reviews. Usually the reviews are done in record keeping, but they sometimes break that out separately. I'll make this one, I'll change that to red because it doesn't happen all that often. A few. Okay, custody of assets. So let me give you an example. Custody of assets. Let's say cash. This is usually done by the Treasury Department in a company. The record keeping for cash is usually done by the accounting department. So the Treasury Department has a custody of the cash. So they're the ones that write the checks. They're the ones that keep the bank accounts. They're the ones that will set up the bank accounts. They'll do all that kind of stuff. And the record keeping is done by the accounting department. Okay, so, you know, and by the way, if you're wondering about the authorizations, it depends on whether it's payments or receipts, but let's say that for receipts, or actually payments, it could be, there could be a few different ways to do this. Payments authorized by, accounts payable. It's somewhere in the accounts payable function. You'll have that. Okay, so cash, custody asset, Treasury Department has it. The record keeping done by the accounting department. Why don't we, you know, since the Treasury Department, why don't we just let the Treasury Department do the accounting for it? You know, they're the ones that make the training. They're the ones that write the checks and all that kind of stuff. So why don't we just let the Treasury Department do the bookkeeping for it? Yeah, and they're usually accountants anyways. I mean, you know, half of them are going to be accountants in there anyway. So why don't we just have them do it? What could happen? What would be the problem? Having, why don't we just do this? Okay, take away from these people. Have them do the record keeping also. Well, the problem is, if they have access to the cash, they can make payments out of the cash accounts, right? And if they're doing the record keeping, you know, they could make the cash disappear out of the bank accounts. They could also cover it with the accounting. How do I undo this? So for that reason, they keep these separate, because if they were able to do the record keeping in the Treasury Department, they could make the cash disappear, and they could do it on the books too, on the accounting side. Whereas you keep them separate, they can still steal cash out of the Treasury, but it's going to be caught. You know, because the accounting department is going to say, okay, wait a minute, why are these, you know, we got this bank statement that is off by $20,000 or whatever it is. You know, where'd that $20,000 go? And then they'll look and find it. But the reason being is that you don't want to have these people, you want to have someone having custody of the asset with the record keeping. So you try to keep all three of these separate. Right? And you do that as a preventative measure. It actually does two things, actually. First of all, if there's something bad that happens, it is usually caught. The second thing is it also helps the people that are involved in it so that they do not get, say, accused of, you know, if cash does end up coming up short, it actually, if you have these controls, if you have these things separated, it keeps those people from being, say, falsely accused or under suspicion of taking it. You know, if money does come up missing, they say, well, check with accounting. What, you know, what do they say? Where, you know, they're the ones that are doing the bookkeeping for this, so they should be the ones that, you know, can find it or whatever. So it actually helps protect people too, who have nothing to do or, you know, with any of the problems. So you're going to keep all three of those separated. And usually when you run into a problem where somebody is stealing from the company, especially, it's because they're given two of those activities. You know, at least two of those activities. If you get all three, then, you know, and by the way, if they are given more than one of these activities, it gets really hard to find it. You know, if they can spend the cash and then cover for the cash in the accounting department, you know, make a payment to their cousin and put it in as you know, whatever advertising expense, it's really hard to find it. You know, so one of the things is, you know, it makes it difficult if duties aren't segregated. So segregated duties, these are sometimes called incompatible duties. I misspelled a word. What a shot. Okay, let's see. What's that? So these are also called incompatible duties. Same thing. So when they talk about incompatible duties, man, I've been talking. It's 7 o'clock already. I got through one page. What's the matter with me? Okay. I'll go do the understanding of internal controls, and then I think we'll take a break. No, I won't. I'm going to stop right here for now. Here's what I want you to do. Pull up that the Fast Fun Footwear thing. If you don't have it, it's in Blackboard. So pull up this case, and we'll talk about it when we come back. So why don't we say be back at what time is it? I'll say be back at 7:10. And go ahead and read this this case, and we'll go over it. It's not a difficult case, really. It's just something that you sometimes have to do as a accounting person, auditor. Okay, so read the Fast Fun Footwear, and we will talk about it at 7:10. Hello? Okay. Excuse me. Okay, Fun Footwear. So, Fun Footwear, they have the shipment of shoes came in and the shoes went missing. And we had salesperson A who angrily replied, "Are you kidding me? This is BS. I've worked here for 5 years. If you think I stole a stupid box of shoes, then you're nuts." And salesperson B, "I couldn't have taken the shoes. I was in front of the store all day with customers. Look at my register tape. All my sales were all shoes from the front of the store. The customer probably took the shoes while we were busy with other customers." Okay. So, well, give me a nasty message here. Oh, I know. We could do the Zoom thing. The Zoom thing.
Poll.
Yeah. Let's do a poll. So go ahead and put in the poll. This will just be one question. I know you guys are gonna have to put. You're gonna have to. There's no question for 2 through 9 or 2 through 10, but go ahead and for just question 1. So is it most likely A, which I think was customers, B, which is salesperson A, or C, which is salesperson B? In the future, I'm going to change that to be A. Salesperson A will be A, B, and C will be customers. You use this for today. Come on, you. Ah. Bad mark. I hate, you know what I hate about computers nowadays is when you're trying to do something, they try to guess what you want to do rather than just doing it. It's like that with a lot of this stuff. Oh, do you want to expand this all over the screen? No. If I wanted to expand all over the screen, I would click on maximize or whatever. So anyway. So which would be the most likely suspect or suspects for the crime? I should make like a 5 one. I should make an additional multiple choice ones. The problem is you have to have them. It has a set number. It'd be great if you could just say, okay, A through E. They have 3 of them. A through E, I have whatever. It doesn't let you do that though. And by the way, there is obviously no right or wrong answer here, so don't be afraid of, oh gee, I might put the wrong one in, because truthfully, without any more information, it could be any one of these 3. The question really is which ones are more likely to be, which one more likely to be A, customers, salesperson A, or salesperson B. Is anyone still voting or no?
I just did, but what was question 2?
There isn't one.
Oh.
And that's the unfortunate thing about the polling.
So what do we do for 2? Just put anything so we can submit it, because we can't submit it unless we choose something else.
Yeah, isn't there a none of there's no?
Yeah, there's no question option
At the very bottom of it, I think. Yeah, you could actually put in anything for them, but yeah.
Oh, okay.
Yeah.
Oh, we got to put in no question. There's no question.
I know. I'll maybe I'll make a few of these that are different lengths.
Okay. All right. 1 second. Okay, still didn't let me do it. Oh, here it is. Now. Okay.
Okay. All right. Well, let me share it. Is there anyone else? There's 6 or 7 people. Is there someone else still working on it? You can put it in chat if you are. If you don't want to say. Okay, I'll go ahead and end the polling. All right, and share the results. Okay. Most people would choose. Most people that are familiar with this kind of stuff. The most likely person would use salesperson B. Let's go and see. We'll kind of walk through it a little bit. First of all, it's a shipment of 12 pairs of shoes. Now, it is possible customers could come in and steal 12 pairs of shoes. It's probably a little less likely. And if you think about it, most people would probably more likely steal shoes that are their size rather than, a random big box of shoes. Now, if they could do it, maybe they would, but it'd probably be less likely. Not that it's impossible. None of this is impossible, but it's less likely. Okay, let's go to salesperson A. Anger is the normal reaction to somebody who is falsely accused. They generally aren't there to explain their side of the story. They generally react with anger. That's the normal thing. So if somebody blows up and acts with anger, that is usually the normal reaction you would expect for somebody who's falsely accused of something. Not all the time, obviously, but yeah, that usually is the case. Now, what is unusual about salesperson B?
He said they said a customer probably took it. How, if they were all busy, how did they know?
Yeah. And one of the key things here too, a lot of times people that actually do fraud or, in this case, theft or whatever, they a lot of times will use vague terms. They are not going to be nailed down to something. So they'll use terms like probably, maybe. They're trying to give you an alternate, give you an alternate thing that could have happened.
Mm-hmm.
And so a lot of times they'll use vague terms like that. So probably, maybe, could have. Those are kind of vague terms that there's really no reason for them to be in there. There's a few things, saying I couldn't have done it. Well, yeah, you could have, things like that. Or sometimes they would. Another thing that is very common is I think I had it in there. I think I took it out. But another thing here. Well, let's go through this one. I was in front of the store all day with customers. Okay, they didn't know if the shoes were actually put on the floor or not. So this would indicate that whoever, they knew that the shoes must have been in the back. because the person said, that they didn't know whether they were put out front or not. And that would be another thing that would be, if you talk to people kind of being vague about it, of, whether they, well, I don't know, could be, maybe, that sort of thing. So I'll give you an alternate. Another thing that is common that you'll get sometimes when somebody is doing something, generally speaking, a lot of times things like fraud and theft and those things are not rational. They're not. I mean, I've seen people that have lost $100,000 jobs for a few $100s worth of theft and stuff. So it's not rational. A lot of times stuffs are not rational, and things like shoplifting and that a lot of times aren't rational. You see people who get caught shoplifting who are millionaires, and well, it's not rational. A lot, and here's the thing: a lot of times people will try to force you to explain their irrational behavior, and they'll say things like this. Oops, they won't do it in caps. That's just me. Why would I? And then they go on to whatever it is. Why would I steal the shoes? I already have shoes like that. Why would I steal the shoes? I don't even think they are that. Whenever they say, why would I? That is putting the kind of the onus on you to explain their behavior as if there is a rational, that it's rational. So it's trying to get you to explain their irrational behavior. So why would I? A lot of times it's something that's used commonly among people, especially if they're, if this is a pattern for them of putting it on somebody else to explain, something. Why would I? Whatever. So again, it could be A, B, or C. There's no definitive thing here, but certainly, people that, first of all, people generally react in anger if they're falsely accused. A lot of times people will also have an alibi all set, ready to go. If, it couldn't have been me. I was in the back. They have an alibi. If you say, well, where were you? Is it, someone who really didn't know, I don't know. I'm working in a store. Okay, I'm working in a shoe store, wherever I'm supposed to be. That's right. They usually don't have that built-in alibi. Oh no, I was nowhere near them. I was. They don't have that. So again, and sometimes when you get into this kind of stuff, you are kind of just looking for those things that might indicate more likely. You might, again, by the way, I should also tell you on something like this. Even if you do find who did it, what do you do with it? So suppose you found out who did it, whoever it was. What do you do with it? You could file a police report with it, and that would probably be the most obvious thing that police would do. Do you accuse them of theft?
Are you speaking, Professor, from a management point of view or the auditor?
Either one. From a management point of view or from an auditor point of view. Now, from an auditor point of view, let's say you were an auditor, you found this, you'd write this up. But here's the thing. Theft is a crime. Embezzlement's a crime. Fraud is a crime. Notice that, generally speaking, that these, if you find something like that, these are not people that have been convicted yet. Those are, you're accusing someone of being a criminal who's never been convicted of being a criminal, or may have never been convicted of being a criminal, and certainly not for what you found. So you'll see cases of people come and say, some person, this guy was embezzling money, the company fired him, and he turned around and sued the company and he won. It's like, yeah, because they accused him of embezzlement and he was never convicted of embezzlement. you accuse them of a crime that they've never been convicted of.
Hmm.
And some people say, well, I know, I'll go to court and I'll prove it. I'll go to court and prove it. So, someone's, sues you for slander. I'll go to court and I'll prove that this person does it. You can't prove a crime in civil court. Civil court is just for monetary things, and it's a preponderance of evidence. A crime is beyond a reasonable doubt. You can't prove a crime in civil court. Right? So, for the most part, I warn people, don't come out and accuse somebody of a crime. You're not a judge, you're not a jury, you're not a district attorney or anything like that. So you are leaving yourself open for lawsuits if you do that. Now you can certainly go, turn the case over to the police. The police may or may not prosecute. It just depends. So there are things that you can do. But what you should never do is accuse somebody of a crime that they have not been convicted of. And by the way, when you write these things up, if you're an auditor, you find these things, because a lot of times you do get called in for stuff like this. We found that, and there's stuff missing at this warehouse or whatever. You get called in and you start looking around and seeing what you figure out. You do things in kind of in vague terms, in that you will list, not by name people usually, but you'll say, okay, the shipping supervisor, whatever, had access to this place. This is where the inventory was missing from, and whatever it is. You never list a crime, and B, if you can, never list their names. I mean, and generally speaking, that's those are the kind of the two cardinal rules. They might, someone in management or upper management will say, well, who is it? What they do? What was the crime? Don't fall for it. And by the way, things like slander, and that it only has to be communicated to one other person, to be a case. Now it would, the court can rule on how much of that damage someone's reputation. But anyway, you generally don't just go off and start saying, this person committed a crime and this is it, and that sort of thing. If you turn it over to the police take it, they prosecute it, and the person is found, then you can say, they've been convicted of theft. This person stole. This person's a thief. But you generally can't say that right when you find the evidence and so forth of it. Even if it's even if it's overwhelming evidence, you still can't do it. All right, let's go back to. Okay, so the we're done with this. Okay. Oh yeah, we're done with that. I'm going to leave that up. I'm going to change this around. I was done this in classes, and it never occurred to me that we would have a poll. So I'm going to leave that up so that I correct it. Okay. How do you get an understanding of internal controls? Well, inquiry, simply asking people. So asking management, supervisor, staff personnel. You can ask people on the production floor too. I mean, you operating people. A lot of controls are actually done by not management people. And you ask somebody who's, say, filling orders at an online warehouse or something. You talk to them about what they actually do, and that's you're getting understanding of the controls. And they may be doing things that they don't even recognize as being controls. They don't have to recognize those as being controls, but you would recognize those as an auditor. Inspection of an entity's documents and reports. In general, well, I guess it really kind of depends, but in general, the company's documents and reports, is that great evidence or not so great evidence? Is it good evidence or not so good? What do you think? what's the problem with these? They're created by the client and they're held by the client. So simply inspecting some of the documents may not be exactly the best evidence. Some of these other ones are a little bit better evidence. For instance, observation. If you observe something, someone actually doing something, notice that that's your own observation. You're actually watching them do it. Now, it could be that they know you're watching them and they're doing it differently, but generally speaking, most people in operations are just doing their job and they don't care. They don't care about the auditors. But anyway, so observing somebody is actually better evidence than, say, looking at the documents. The documents may say, oh, all employees do X, Y, and Z, and you observe them and they don't do that. So these are some of the things that you're going to have. Tracing transactions through from the beginning to the end. Those are things that you're going to do. They give you an idea of the understanding of the internal controls, and the best ones are usually, certainly I think of all four of those. Probably observation and maybe tracing are the best two.
Is there a way would you put those in the order of what's one of like far as the best to the least?
Yeah, I'm going to put it in this order. Observation is probably the best. It's your own observation. You're actually watching somebody and doing what they're actually doing. There is somewhat of an art to that. You don't want to be creepy about it or something. But so watching people do stuff, and I can't tell you how many times I've watched people. I've been told that they do things a certain way, and you go see what they do, and it's completely different. So observation is actually a pretty good one. Tracing the transactions through, that's good because a lot of times you deal with like the source documents, and then you can actually walk it kind of through the system and see how it gets to the financial statements. Inquiry is a good one. However, what's the problem with inquiry? Just asking somebody.
They can just tell you whatever they want.
They can tell you, they could lie to you. I had a funny supervisor one time when I was telling him something about, then this guy said this and she said this, whatever. And he just stopped me and said, "Mark, let me tell you something. People lie." I know. and they'll lie to you. I said, okay, I know. But anyway, the problem with telling it, A, they could be lying, or B, a lot of times they're not lying. They're telling you what they think it actually is. They could also be telling you what they think you want to hear. So there could be a number of things going on there. Part of communication is, they could be outright lying to you for whatever reason. They could also be telling you what they think it is, or they could be telling you what they think you want to hear. And so then you get this kind of muddled thing that asking people sometimes is not necessarily the best. Now, having said that, a lot of times, inquiry, program management, and stuff like that, you'll actually find something. I think I told you one thing about fraud. One of the ways that people find fraud a lot of times is by asking. People will sit there even if they know that there's a fraud going on and not say anything. And then if someone asks them, they don't lie. They'll just tell you. So sometimes inquiry is actually, it can be very useful. But there's also a problem with it is communication. In inspecting the entities, their documents and reports, again, a lot of times, first of all, those are made by the client. They could be deceptive. They could also just be out of date. When I was doing auditing, virtually every operational manual and all that kind of stuff that I ever looked through was out of date. It was something for a system, a computer system that they haven't used for 3 years. And, there's just all kinds of stuff that was, they just were not up to date. And if you think about it, into these documents, I'll tell you from the places that I worked at. For instance, let's say that there's an accounting manual. I worked at for Navistar and US Steel. Let's say I'm working at US Steel. An accounting document, and it's out of date. You might be upset about, why isn't this up to date? Was it? U.S. Steel does not make money making accounting documents. You know, I mean, that's just the fact of it. They don't make money making accounting documents. So a lot of times things like that get pushed to the back, you know, that. So while it should be up to date, they should be, you know, able to be relied upon and all that kind of stuff. They often aren't. Okay. Entity level controls. I know there's like a shopping list here. I'll tell you something funny. You know, there's a whole page of them here, but that I cut this down. There's about half as many as were on there at first. So these are controls that are throughout the entire company, and these are things that can have an impact on the financial statements. I'm just going to pick out a couple of them that are more important than others. One of the things is a whistleblower hotline. You would be surprised how many times fraud is found this way. Whistleblower hotlines are very good. Tone setting, we talked about this. Tone at the top. That is huge. As far as, you know, people generally behave in the company the way the people in upper management behave. It's just the way it is. Those are the jobs they're looking to get. Those are the people that are influencing them, and so on and so forth. And so the tone at the top is actually a very big one. So these are some of the things that go throughout the company. You can look through these. I'm not going to get too far into them, but some of the stuff we'll talk about later. And again, it's a shopping list, right? I mean, it's just huge. Okay. Documenting internal control. There are actually, you know, so once you get an understanding of the internal control, now you have to document it. The work papers are set up. Let me write this in here. Talking about it probably isn't right. Work papers are the auditor's work papers are the auditor's evidence that an audit was professionally completed. The auditor will rely on the work papers They'll rely on the work papers if they're sued, or even if they're brought into a criminal case. So the work papers are your evidence. It's sort of like you are preparing for a court case with your work papers. So that if you get brought into court and someone says they didn't do their job, you can pull out the work paper and say, yes, we did. You know, here's the test we did. Here's the whatever we did. So you're those work papers are very important as far as the auditors are concerned, and that's one of the reasons why they own them, is that if they are sued, if they are brought into court, they're the evidence that we have that we did our job. You know, and you know, does it happen that audits fail? Yeah, there's a reasonableness thing in there. And even if you audit to the 99% level, what does that mean? That means 1% of the time you're going to be wrong. So if you know, by the time you get to your 100th audit, well, you're probably wrong on one of them, right? So, you know, the audit work papers are key. So you document everything that you do, because if you get brought into court, so if you get brought into court and it says you're supposed to get an understanding of the internal control, how did you do it? You know, how did you get an understanding of internal control? These are the three methods you generally have for doing Internal control questionnaire. This one will be I'll do it later. We'll go over it a little bit later. But internal control questionnaire, that's just a bunch of questions that say yes or no to different controls. Do you have this control? Yes or no? Do you have that control? Yes or no? So internal control questionnaires are one way to document it. And if you got called in the court, you pull out that internal control questionnaire and say, this is the internal control questionnaire. This is what we asked the controller these questions, and this is what the responses were, and so far. We followed up in this manner and all that kind of stuff. Flow charts are, you guys probably hear this in management class and that, but you have a flow chart where it'll flow, see what the documents flow to. It's a visual one. It's a visual representation of the internal controls, and people that are used to seeing those, auditors usually, they can usually decipher them very quickly and see where there's a problem or where there are controls that they'll rely upon and that sort of thing. These are usually only for auditors. And they are, and they basically are looking for the controls that we would normally think of, that, who authorizes this, when this is signed, who gets it, how's it going to the accounting system, that sort of thing. I think the mistake, I was doing an audit one time and I was talking to someone in, one of the IT people about a program, and they said, I started talking, and I said, well, I'm going to make a flow chart. And I said, well, we already have a flow chart. I said, oh, really, do you? They handed me this flow chart. And, I don't know what I was expecting, but this thing was absolutely giant. I mean, it had literally like thousands of things, because they do it all for the programming, and they need this, that, and the other. And it was way more detailed than mine would have 50 things on it, and theirs had 500. So it was, I actually couldn't use it because it was, I didn't even understand half of it. So, but anyway, our flow charts are generally, they're made so that auditors can understand them, and generally speaking, they're a quick way for someone to look at it and see what the controls are. A narrative description. This is sometimes called a written narrative, and it's just that, it's just a write-up. Okay, so written description of the controls. And just to let you know, when I was going through auditing, now I was an internal auditor, so we had a lot more time than the external auditors. But at the end, this is what I would do. When I finally figured out what auditing was about, I would just do this. I would go in and start talking to people. The nice thing about written narratives is you can give it to anybody. Anyone can read it. If you walk up to somebody with a flow chart and you say, is this right? They'll have a glazed over look on their face. Walk away from you. But a written narrative, they can read it. You say, well, okay, this part here, yeah, well, we do this, but sometimes it's like this. And then they'll start telling you how they actually do it. And when I would do auditing, I would really get this written narrative down. I would get this so that you can, yeah, that's right. That's exactly what we do. And you go around a number of different people and you get a very accurate document. Once I got this done, then I made the flow chart. I would make a flow chart, and that would be the one that my supervisors and the director, whatever, would look at. But I always got this one down really well because, jumping right into a flow chart sometimes isn't helpful. Now, again, I had a lot more time than the external auditors. The external auditors come in, they have a few days to do something where we may have a few weeks as internal auditors. So I could spend the time to really get a very accurate narrative before I went in. And again, the nice thing is you can hand this to anybody and they can look at it. So these are 3 ways to document internal controls. You can use any one of them or all of them in your audit. You might use an internal control questionnaire for cash. You might use a flow chart for accounts receivable. You do not have to use any one or any of them. you know, you have to document it using one of these, but there isn't one that you have to use. Given, well, you know, you can use any of these are appropriate. In the book, they say procedure manuals and organization charts. You do not, that's fine for the book, but not on a CPA exam. On a CPA exam, they will not consider that to be understanding of internal control. Because, you know, the procedure manuals could be out of date, the organization chart could be out of date. You have to do something besides this to really get an understanding of their internal control. So procedure manuals, well, in the book, it shows that that's not a CPA exam kind of thing. Okay, let me go to the internal control questionnaire. Okay, now internal control questionnaire. These are commonly used by, go back up here just for a second. These are commonly used by external auditors. CPAs. These internal control questionnaires. What you do, you'll have this questionnaire, and the questionnaire will be something that's made up, obviously, ahead of time, and you'll take this questionnaire. They usually have everything in there, even if it doesn't apply to the company, and you'll just go in, and things that don't apply to the company, you cross out, you know, for whatever reason. But anyway, you know, they're usually kind of boilerplate, and that they'll have ones that have everything on it, and basically you'll go in and just sit down with the controller or the assistant controller or whoever it is, and you'll ask them these questions. Now, the nice thing about it is you could be, you know, a brand new auditor on your first day on the job, and they can give you this internal control questionnaire and say, here, take this in there, go ask the assistant controller, you know, these questions, and just, you know, yes or no, circle yes or no on whether they are, you know, whatever they answer. So are all employees paid by check or direct deposit? Yes or no? Right. And probably I think I saw that there's some, I think there's some football player that's getting paid in Bitcoins or something, signed a Bitcoin contract. So that would be a no. No, I pay this guy in Bitcoins. But anyway, so are all employees paid by check or direct deposit? Yes or no?
Yeah.
And yeah, exactly. So usually, you know, yes means everything's okay. So are they paid by check or direct deposit? Yes. If you run into a no, that's usually a problem. So you come down here to our payroll employee department personnel rotated in their duties. You know, they say no. That could be a problem. So yeses are usually okays. So yes, good, or no, bad. Okay. And so if there's a no, a lot of times it'll be that there's a problem. Now it doesn't always, it's not always a one-to-one thing, but yes is good, no is bad. So as you go through here, you know, these will usually be set up. Now, there is a problem with internal control questionnaires. And anybody, you can look through here, and you know, if you look at it, there's everything in the kitchen sink in this thing. So, you know, when you give this to somebody, you have to remember that oftentimes, for instance, someone who's a assistant controller, the controller of the place, a lot of times they came out of public accounting. A lot of times they were external auditors. So, you know, here you are, maybe you had a year or two of experience in auditing, and you're sitting across the desk from somebody who had 10 years in auditing, and you're going through this questionnaire. And they know the game. They're not, you're not doing anything that they don't already know. So as you go through this questionnaire, they know that yes means good and no means bad. So as you go through it, and they want to get rid of you, not because they don't like you, but because they got a lot of work to do, they'll say, yes, yes. Oh, we do that. Yeah, we do that. Yes, yes. Okay, see ya. So you gotta be, so there's that problem that a lot of times the people that you'll be actually asking this question to are familiar with what it is and basically what they mean, what yeses mean, what no means. Oftentimes you will put questions in there that will have the correct answer, or the answer you're looking for will be a no. And a lot of times, so question number 7, yes, will be the right answer. Question number 14 will be no. And so to make sure that they're actually paying attention to what you're asking them and they're being truthful with you, when you get to 14 and read the question, that they'll say no. If they say yes, then obviously they're not paying attention to it and so forth. So you do have some of these games in there that are mixing them up a little bit so that not all yeses are okay and no's are bad. Just because a lot of times the people that you're actually asking these questions to are people who are very familiar with these. They may have given hundreds of these when they were doing Audit. Okay. Risk assessment. I'll do a little bit on this. Let's see here. This page won't take. This page will take a couple minutes. We'll do this one. Okay, so page 5, number 3, risk assessment. At the assertion level. So this is for, usually this is for the specific accounts. Okay, so assertion level, you're talking about specific accounts. What are the risks for specific accounts, and the assertions that go along with them? So cash, completeness, existence, all that kind of stuff. Okay, this is further divided into inherent risk and control risk. We talked a little bit about that already. Inherent risk. I think we did that. Now I'm questioning myself. Did we cover inherent risk and control risk and detection risk and all that? Audit risk? We multiplied them? I'll look into it.
I don't think so.
No? Okay. We identify potential misstatement, and I think we talked about this, I'm not sure. But when we talk about potential misstatement, we usually talk about, the dollar amounts, 10,000, 10 million, whatever it is. And then we also talk about a probability. Is it likely to happen or is it very unlikely to happen, and that sort of thing. So when you look at potential misstatements, you look at the dollar amounts and the probability. So these are kind of the two things that go with it. How bad could it be, and what is the likelihood that that's going to happen? Things that are less likely are going to be less important. Things that are more likely are more important. Bigger dollar amounts. Okay, and you're going to pinpoint the factors that affect the risk of material misstatement, whatever they are, whatever things make it more. For instance, the cash account. Everyone can use cash. if it was a company and I was involved with the cash account, I could steal cash. I would, I want cash. There are some things that nobody wants, and so the risk factors. So cash is something that everybody could use. Accounts payable. No one's going to steal the accounts payable. I'm not going to take the company's accounts payable and go pay off their debts for them. So the cash account is more, more at risk than say accounts payable. That is just liabilities is something you order. Okay, you're going to design test controls and substantive procedures for these. So this is at the what they call the assertion level, and the assertions, you remember, they're the things like existence, completeness. You remember all that stuff. Cut off. Those are all the assertions. Those are assertions. So when they talk about the assertion level, all the different assertions. Rights and obligations and all that kind of stuff. So those are the assertions. And so at this assertion level, so it's cash, is the cash account complete? Does the cash exist that they say they have? All those things are things you're going to test for, and that's at the assertion level. Okay, coming down here, there are also things at the financial statement level that increase the risk. And so these are things that would make the financial statements as a whole would make it more risky. Okay, so so this would mean a risk on the company as a whole. So beyond just any given account. So up here you're looking at the accounts, cash, accounts receivable, whatever. Down here you're looking at risks that would be overall that would make it more likely that something could go wrong. Management's incompetence. If you have management that doesn't know what they're doing, a lot of times, that will mean the financial statements may not be prepared correctly. If they're not, if they don't know how to make the financial statements, that could be it could be a part of the problem. We had a controller one time in one of the assembly plants that we had. She actually wasn't incompetent. She was very smart. She was a very smart chemical engineer. I have no idea how this happened, but they took this person who's a chemical engineer and a computer programmer. She did amazing stuff for the programming for the place, and incredibly, they gave her the job of controller, which is all dollars. And you could tell when we went through the audit, there was all kinds of problems with it, and it had to do with she wasn't an accounting person. So it looked like that she was, didn't know what she was doing. She was incredibly intelligent, obviously, but in accounting, she wasn't competent. It really, they should have had somebody at least come in and show her how to do the accounting side of it. But again, it really wasn't her fault. It was just that they had given her a job that was not compatible with what her expertise was in. So yeah, but there's all kinds of stuff that went on in that one. Poor oversight by the board of directors. Board of directors are hit or miss a lot of times. I see board of directors that are very active, and there's some board of directors that they don't do anything. They meet every 3 months and eat cookies and drink coffee and gab about stuff and leave. That's just what they do. So it really depends on how much the oversight. But if they have poor oversight, that means management a lot of times can do what they want. Here's one that's important for today: declining economic conditions. This COVID thing put a lot of pressure on companies. A lot of companies that are doing poorly just because of this COVID thing. So declining economic conditions, this makes it more likely that there would be some pressure to have materially misstated financial statements. Bankruptcy, same idea. These are sometimes called going concern problems. They're the same thing. Going concern or business risk problems. But bankruptcy is another one of those things that if a company's going bankrupt, they have more, I won't say incentive, but there's more of a immediacy that it might become things that they wouldn't normally think of doing, they start thinking of doing. All kinds of bad ideas come out when the economy goes bad or a company's going bankrupt. They're in a rapidly changing industry. The two that come to my mind are streaming services. These streaming services are now huge, and things like delivery services like Uber and these meal delivery ones and all that kind of stuff. Those are industries that no one really knows how they're going to play out. They're changing a lot. They're doing things that no one ever thought of, and when you have that kind of a thing of a changing industry, it means that there could be things that go wrong when it comes to the financial statements and how to do it. And this one, a domineering executive. That's what I was going to do. There's actually a case I'll give you guys next week. It actually has to do specifically with this. But a lot of times, if you have an executive that runs everything, and everyone's afraid of him or her, and they whatever, that can be a real problem, because a lot of times they will say, do it this way, and whether it is the way they should be doing it or not, if they just get their way. So a lot of times, if you have someone who's overbearing, especially if it's one person, you run into that. Okay, now a couple things. This is somewhat new. We were always looking for material misstatements in the financial statements. That's what you do. You look for material misstatements. But auditors are now required to assess the risk of management fraud. So they have to entertain the thought that management might be fraudulently cooking the books, enriching themselves, or whatever it is. So it's a fairly new requirement, but that and this is very different than in the past. In the past, it was simply misstatements. We look at misstatements and we don't really care why. Misstatements could be because of errors, it could be because of fraud, whatever it is, we don't care why. Nowadays, it's different in that you must look for management fraud. And by the way, a lot of times for companies, if their financial statements are misstated, a lot of times it is management fraud. Because if you have millions of dollars in error, a lot of times it'll hit somebody's budget and they'll make, well, what is this? What's the $6 million come from? So a lot of times if no one says anything, it is management fraud. They know, they're not questioning the $6 million charge because they're the ones that came up with it. Okay, so you must at least entertain the idea of management fraud. I'm gonna stop here. I know we didn't get through the whole thing, but we'll stop right here. So this will be our stopping point. Hey, okay, so what I'm going to do is once I leave here, once we wrap this up, I'm going to put the thing to submit the monetary unit sampling, so you guys can submit that. We went through the page 6 and that on there, so you can submit that. And by the way, that is the last of the sampling stuff that we have. So either next week or the following week, we'll have a review on sampling, and we'll go through classical sampling, the test and control stuff, and we'll do the monetary unit sampling, and just review all those, and then I'll give you guys the test of the sampling. But we'll, I probably won't do it next. I'll probably do it the week after. But when's the spring break?
At April, around April 12th or so?
It's towards the end of April.
Yeah, it is April 12th.
April 12th.
Okay. So that would be, okay. So it's not next week, not the following week, but the third 3 week. Okay. Yeah, so probably like a couple of weeks, not next week, but the week after, I'll probably go ahead and go do the sampling review, and then give you guys the sampling exam. You have a week to finish it. So, well, actually, no, you'll have 2 weeks to finish it because it'll be over break. So anyway, yeah, so we'll count on that in 2 weeks. So next week I won't have it. I mean, I have it done actually, but I'm not going to give it to you guys until 2 weeks from now. That'll give people time to get turn anything else in that they need. Okay, so hold on to the chapter 5 handout, and I will talk to you guys in a week. All right.
Professor, I have a quick question.
Sure.
I know you probably went over it right at the beginning of the class, but I had stepped away. Why didn't we do anything with on problem 6, the 13,000? Because it was no error. It was more of just an it was just understated by that amount.
The 13, let me pull it up.
Yeah.
Wait, I don't have my screen on. Okay. Yeah, the 13,000. That's the cookie one. That's the one where the. That's a good question. So the 13,000. It's a projected misstatement. Right. It's actually an actual misstatement, to be honest with you. The book is this account is actually off by 13,000.
Right.
So this is an actual misstatement of 13,000. It is not really a projection. All right. Now, the incremental allowance, so it is included in our projected misstatement. Our projected misstatement says, okay, it's in there. So it'll be 25,000 plus 13 plus 100. So it's in the projected misstatement. So this is up by 13,000. Now, here's the thing. The incremental allowance is for the idea that if something is misstated, that in that interval, there could be more things that are misstated. The idea that there's a probability now that if you do find an error, it increases the probability that there could be more errors.
That's why we allow for the incremental allowances.
Exactly.
Because it could be more error. Okay.
And now, if you think about this one, it couldn't be any worse. This covers the entire interval. There's nothing else in this interval that could go wrong.
Right.
So that's why we don't put it in the incremental allowance. So it is included in the misstatement. And I know it says projected misstatement. This is truthfully, it's an actual misstatement. But
they still go in that amount of the 138, correct?
Correct, absolutely correct. Yep. Okay. And so it'll be in the 138. Coming down here to the bottom, when we do this down here, it's not in the incremental because, again, it couldn't get any worse. And down here, you'll notice too, this incremental allowance, it matters how big the error is. And because the error is fairly large, that's why this is fairly large. Yeah.
Okay.
So it makes a difference. If it's off by $100, it's different than if it's off by $100,000.
So basically that 58,000 give it a little more room for error. Is that what it is?
Correct.
Okay.
Yeah, and if you think about that one, the entire interval could, it could have more errors in it. Now, I said that wrong because it goes by the book value, so I said that incorrectly. It should be 88,000 of the interval could have more things wrong with it.
Got it.
Yeah, it's a weird method. And the thing I don't like about this incremental thing, it would be so easy to make a table that had these incremental amounts. They make us do this calculation here. There's no reason why you couldn't make a table that had instead of those two and subtract, move on and get that. There's no reason why you couldn't have a table that just had those. You know, first one's at 10%, the first one's 58, second one's 44, next one's 36. You know, there's no reason to have a table that had that on. But anyway, that's the method.
Okay. And I have one more quick question. It was about the exam.
Okay.
So because that $380,000 was so close to the net income amount, that's the reason why that was considered material?
Yes. And I think I'm going to, I'll do this. For the people that already turned it in, if you answered it correctly.
Oh, I'm sorry.
I'll give you extra credit points on it. No, but you actually asked a good question.
Oh, I'm sorry. I thought we all turned it in.
No, so I think there's some people that have. Now, if you haven't turned it, let me do something here. I am going to get a screenshot of people who have not turned it in yet. So that, but if you've already turned it in, I think I'm going to give extra credit points on that. And okay, yeah, it's exactly what you said. The misstatement was for 380, I think.
Mm-hmm.
The net income was only 310. So, you know, if the revenue is too high by 380, that must mean that 310 was actually not 310, it was a loss. Mm-hmm. So that's one of those things that would be a qualitative.
Qualitative. Mm-hmm.
Yeah, so even though dollar-wise, absolutely correct, it's not material.
It's not quantitative, but it's qualitative. Right,
because the company, it moves it from being a company with a loss to a company with income, which is different. You know, that is material. So yeah, that was a quirky one. But anyway, so that was a reason. Yeah.
So it's not quantitative by the dollar amount.
No, it's definitely not. You know, firstly, any method that you use would come up being not material.
But it is by qualitative. Okay.
Yeah, and as I went through there, this is one of those things that, you know, from my perspective is different from the student's perspective, because many, if not most, of the students missed that one. So I'm going to add that back in to those as they go through them, just because that's one of those things that, you know, if a couple people miss it, that's probably them. If the whole class misses it, it's probably me. So that one is going to be, I'll add that back in.
Okay, cool. All right. Thanks.
So yeah, but that's the reason why it changed it from.
Because that's a big thing, because you're negative now.
Exactly. It is at a loss in the company that has income, even if it's a small amount.
Right. Okay.
Okay. Any other questions? Okay. Well, I will talk to you guys the next week. So the only thing I turn in is that monetary unit sampling. So I'll put that in when I sign off. Any questions? Okay. I will see you guys.
Good night. Thanks.
Thank you, Professor. Have a good night.
Good night.